Welcome back. Today we're diving into an explainer on a topic that is absolutely crucial for any business. Now, when you hear the phrase capital budgeting, your brain might immediately jump to, dusty math and a back office. But let's completely reframe that right now. Capital budgeting is actually the ultimate high-stakes corporate fortune-telling tool. It's literally how the world's biggest companies decide whether to drop millions or even billions of dollars to shape their future.
So, here's our roadmap for demystifying these massive investments. We're going to hit high-stakes capital budgeting, time, money, and opportunity, decoding net present value, real-world NPV examples, and finally, alternative capital budgeting tools. Let's get right into it.
Starting off with Section 1, high-stakes capital budgeting, and the risks of guessing wrong. Think about it. When a business builds a massive factory or launches a global campaign, they're laying down huge amounts of upfront capital way before they see a single dime in return.
The risks of poor planning here are absolutely monumental. I mean, if you miscalculate your costs using bad data, you end up like Tesla's early solar roof rollout, just facing massive delays and bleeding cash. Or if you ignore customer trends, you become Blockbuster watching Netflix completely take over the world. And hey, even with perfect math, you might get hit by strict new regulations like Airbnb did, or totally unpredictable black swan events, like the Boeing 737 MAX delays caused by global COVID-19 cancellations. So rigorous planning isn't just a nice-to-have. Survival literally depends on it.
Moving right along to Section 2, time, money, and opportunity, the invisible forces. Because before we even glance at the math or the formulas, we absolutely have to understand the foundational philosophy driving all these financial decisions.
Okay, here's the golden rule. Every single time a company spends money on a huge new project, they are actively giving up the chance to do something else with that cash. That's opportunity cost. You know how if you spend an hour watching a movie, your opportunity cost is the hour you could have spent reading? Well, in corporate finance, if you drop $1 million on a new factory, your opportunity cost is the return you could have made investing that million somewhere else. Let's see how this actually plays out. Imagine a company is sitting on a massive mountain of cash. They could just leave it safely in the bank and earn a guaranteed 8% return. That's their baseline, right? So why on earth would they ever take on a risky new corporate project? Well, that new project has to project a return significantly higher than that guaranteed 8%. If the risky project is only going to return 5%, yeah, terrible idea. They'd literally be losing out on the 8% they could have had risk-free.
Which brings us to this absolutely crucial principle, the time value of money. $100 in your hand right today is inherently worth way more than a promise of $100 a year from now. Why? Well, inflation is always eating away at purchasing power. Plus, there's the risk you might never actually get paid tomorrow. And going back to opportunity cost, if you have the cash today, you can invest it immediately and start growing it.
All right, with those concepts locked in, we're jumping into Section 3, decoding net present value, or NPV, the ultimate metric. This is how financial managers actually evaluate if an investment is worth it. Now, NPV sounds super complex, but evaluating these investments really just breaks down into 3 logical steps. Step 1. You map out every single dollar moving in and out over the project's entire lifespan. Step 2, you strip away the distortion of time by discounting all those future dollars back to what they'd be worth today based on your required rate of return. And Step 3, you just subtract your massive initial upfront investment from that present value to see what's left over.
When you do this, you're basically tracking a massive ledger. On the outflow side, you've got your initial investments, your ongoing equipment repairs, and cash tied up in working capital. On the inflow side, you have your new revenues. But, and this is a huge but, remember that things like cost savings count exactly the same as new revenue. Like firing up a more efficient machine that needs less labor, that's an inflow. You also toss in the salvage value of reselling the equipment at the end and the recovery of your initial working capital.
So, once you crunch all those numbers, you arrive at a single figure. And the ultimate goal of NPV is to get a positive number. A positive NPV means the project is actively creating value for the company above and beyond their required rate of return. A negative NPV? That means the project destroys value and you should immediately throw it out. It really is that definitive.
Let's move into Section 4, real-world NPV examples, putting theory to the test. Because honestly, concepts like discounting can feel a little abstract until you see them in action.
Let's look at the absolute simplest form of NPV. Imagine you buy a fixer-upper house. You spend $250 grand to buy it and another $250 grand fixing it up today. That is a $500,000 outflow right now. But 1 month later, you flip it for $600,000. Since the turnaround is practically immediate, the time value of money doesn't even really matter here. You don't need to discount anything. You put in $500K, you got out $600K, and boom, you instantly created $100,000 in pure value.
But watch what happens when time stretches out. Take this organic fertilizer startup. Today, in year 0, you've got a negative $28,000 upfront cost. But then for the next 10 years, the business generates a steady positive return of $5,000 every single year. Now, you can't just multiply 5,000 by 10 and say, hey, I made $50,000. No way, because those future payments are worth less than money today. We have to discount each of those future $5,000 payments back to the present. Let's assume our company requires a 10% return. By bringing all 10 of those future payments back to today's value at a 10% discount rate, and then subtracting our initial $28,000 investment, we find the NPV is positive $2,722. It's a pretty small margin for sure, but it is a positive number. That means this fertilizer business is creating value beyond our 10% requirement, so it should be a go.
Now, in a truly complex scenario like this one for the Atom Company, you really have to meticulously track and discount varying flows. Notice how we have a massive upfront outflow followed by positive $80,000 flows for 5 years. But look at year 3. Bam! An unexpected negative $40,000 repair cost right in the middle. Then, at the end of year 5, we get a positive bump from selling old equipment for salvage and recovering working capital. You have to discount every single one of these ups and downs across their respective years to see if the final sum is positive. It's basically a giant financial puzzle.
All right, moving to our final section, alternative capital budgeting tools, the alternative arsenal. Because while NPV is the gold standard, what if you have multiple value-creating projects but not enough cash for all of them?
Our first alternative is the internal rate of return, or IRR. Instead of picking a discount rate like 10% to see the dollar value, IRR completely flips the math. It calculates the exact maximum cost of capital your project can endure before its net present value hits 0. So, if your project has an IRR of 15%, it means you can borrow money up to a 15% interest rate and still break even. Anything higher than that, and the project starts destroying value.
Then we have the profitability index. If you've got two mutually exclusive projects that both have a positive NPV, how do you pick? Well, the profitability index is your ultimate tiebreaker. By creating a ratio of the present value of future cash flows divided by the initial investment, it shows you exactly how much bang you're getting for every single buck invested. A PI greater than 1 means it's profitable, and the higher that index goes, the more aggressively it's generating value per dollar spent.
And finally, there's the payback period. This is the simplest and, honestly, kind of the most flawed tool, but it is super widely used. It simply tells a nervous investor how fast they'll get their initial cash back in hand. If you invest $100,000 and make $20,000 a year, your payback period is 5 years. The problem? It completely ignores the time value of money, and it totally ignores any profits or losses that happen after that break-even point. It's a quick risk assessment tool, definitely not a true measure of overall value. Ultimately, whether you're relying on the meticulous math of net present value to account for time and risk, or you're using the profitability index to squeeze the most out of your budget, the core framework here is incredibly consistent. It's all about peering into the future, weighing those invisible forces of opportunity cost, and protecting financial health. And that leaves us with a question for your own financial decisions, whether they're personal or corporate. When you spend your time and your money, are those investments actively creating value for your future, or are they destroying it? Thanks so much for joining me on this explainer, and keep making those value-driven decisions.